In March 1933, every bank in America closed. Not one or two, all of them. The government ordered it. The public accepted it. And the financial system, suspended in midair, didn't collapse. Instead, it rebooted. What looked like chaos was in fact design. Underneath the headlines about panic and depression, something more precise was unfolding. A national banking freeze, executed with surgical speed, gave the federal government total control over liquidity, withdrawals, and, crucially, trust. But here's the part that's rarely mentioned. Within 72 hours of the closures, gold ownership was criminalized. Private citizens were forced to turn it in. And within weeks, the US dollar was quietly devalued by 41%. The people never voted on this. Congress didn't debate it. And yet, overnight, the entire structure of American money changed. It was called a bank holiday, a warm, almost cheerful term. But the mechanism? It was a financial state of exception, a moment when normal rules were suspended in the name of stability. It was emergency liquidity control, executed through mass closure. And it worked. For nearly a century, the 1933 bank holiday has remained a historical anomaly, a bold, one-time intervention in the darkest hour of the Great Depression, a distant lesson in crisis management. But now, for the first time in decades, its architecture is re-emerging, quietly, digitally, and globally. Imagine the same logic, total account lockdown, currency transition, trust reset, applied not through paper doors and vaults, but through code. Through programmable money, instant central directives, and invisible permissions. Not a holiday this time, a switch. What does that mean? It means that the emergency mechanism once used to close 20,000 banks could soon be run from a dashboard. Some historians believe the 1933 move was the most radical financial operation ever conducted in peacetime. But what if it was just a prototype? The year was 1933. America was not just in crisis, it was unraveling. By March, over 11,000 banks had already failed since the start of the Great Depression. Depositors were losing their life savings, not to inflation or market swings, but to silence. Doors closed, windows darkened, and the money inside? Gone. There was no federal deposit insurance, no safety net. When a bank failed, the damage was permanent. Fear spread faster than facts, and bank runs became a daily spectacle, crowds demanding cash that no longer existed. The government was paralyzed. President Herbert Hoover had resisted intervention. The system, he believed, would correct itself. It didn't. Confidence evaporated, and in its place came suspicion of bankers, of currency, even of the dollar itself. Gold was hoarded, cash was hidden. Withdrawals became a self-fulfilling prophecy. The more people rushed to get their money out, the faster the system broke. By early 1933, the financial bloodstream of the nation had nearly stopped. Into this environment stepped Franklin Delano Roosevelt. Inaugurated on March 4th, he faced not just a broken economy, but an existential question. Could Americans still trust their money? Roosevelt moved immediately. On March 5th, his first full day in office, he invoked the Trading with the Enemy Act of 1917. Originally designed for wartime powers, it now became the legal foundation for financial lockdown. The very next day, March 6th, all banks in the United States were ordered to close. Not just the failing ones, all of them. It was not a suggestion, it was a federal mandate. Framed as a holiday, it stripped every financial institution of the ability to operate. No withdrawals, no transactions, no exceptions. And the public obeyed. The justification was straightforward, to prevent further runs and allow the Treasury to inspect each bank before reopening. But the scale was unprecedented. Behind the scenes, teams of federal examiners were dispatched to assess solvency. Radio broadcasts urged calm, and for the first time, the entire U.S. financial system became functionally a single institution under federal control. Mechanically, it was brilliant. Psychologically, it was disarming. The term holiday softened the edges. It sounded temporary, even festive. But legally, it was a suspension of financial rights. The public could no longer access their own money, not because they had done anything wrong, but because the system couldn't guarantee it existed. Then came the gold order. Issued just weeks later, Executive Order 6102 required all citizens to hand over their gold holdings, coins, bullion, and certificates, to the Federal Reserve, under penalty of fine or imprisonment. In return, they received paper dollars. At first glance, this seemed like a patriotic sacrifice. In reality, it was a forced conversion, a transformation of private value into centralized control. And what followed was the final move. The government raised the price of gold from $20.67 to $35 per ounce. That single act devalued the dollar by 41%, inflating the Treasury's gold reserves overnight. It was, in effect, a reset, but not of the economy, of the public's relationship to money. Before 1933, currency was a promise, backed by gold, held in trust. After 1933, it became a command, issued by decree, backed by faith in government. The banking holiday wasn't just a pause, it was a pivot point, a moment when financial sovereignty shifted from the private sphere to the federal. From this context, one truth becomes clear. The system was not rescued, it was redefined. And once a precedent like that exists, it doesn't disappear. It waits, in law, in memory, in mechanism. By the time Roosevelt ordered the bank holiday, the banking system wasn't just unstable, it was mathematically insolvent. On paper, banks held deposits worth billions. In reality, they held a fraction of that in liquid reserves. The rest had been lent out, lost in market crashes, or frozen in illiquid assets. The public began to sense this, and when trust disappears in a fractional reserve system, speed becomes the deadliest force. Banks don't die slowly, they die in days. Between February and early March 1933, withdrawals surged to catastrophic levels. In just 1 week, New Yorkers alone pulled out over $720 million in cash and gold. Across the country, armored cars became more common than taxis. Governors in Michigan, Indiana, and Maryland declared state-level banking holidays to stop the bleeding. But without federal coordination, each move deepened the panic. If one state was freezing withdrawals, others must be next. The result? National contagion. Roosevelt's closure order wasn't proactive, it was defensive. The system was hours away from collapse. According to Treasury records, gold reserves at the Federal Reserve had fallen below the legal minimum, the level required to support the issuance of dollars. This is the detail most histories skip. By law, the U.S. was still on a gold standard. Every dollar in circulation had to be backed, at least partially, by physical gold. But as citizens rushed to convert dollars into metal, the Fed's gold cushion evaporated. The Federal Reserve Bank of New York, the largest in the system, was within 36 hours of running out of deliverable gold. Had that happened, the U.S. would have been forced to admit the truth. The dollar was no longer backed by anything. That moment, the loss of convertibility, would have shattered international confidence. Foreign governments, already skeptical, were watching closely. If the dollar collapsed, the global post-war economic order, still fragile after World War I, could have followed. So Roosevelt acted, but not by defending the gold standard. He quietly dismantled it. First, the holiday, then the gold seizure, finally, the dollar devaluation. In less than 3 months, America abandoned the very system it had sworn to uphold. And here lies the core paradox. The bank holiday is often remembered as a stabilization effort. In fact, it was a coordinated retreat, a retreat from convertibility, from decentralization, from the gold anchor itself. The banking system wasn't saved, it was restructured under new rules, with new tools, and under new control. That control was consolidated in Washington. Through the Emergency Banking Act, passed just 5 days after the closures, the president gained sweeping power over monetary policy, bank licensing, and gold regulation. For the first time, the line between political authority and monetary power blurred. And the precedent stuck. After 1933, banks could no longer define the value of money through reserves. That power now belonged to the state. The very thing the gold standard had once restrained, discretionary issuance, became the norm. What caused this? It wasn't ideology. It was system mechanics. Fractional reserve banking depends entirely on confidence. Once trust breaks, the numbers no longer add up. There's not enough cash to meet withdrawals, not enough gold to back notes, not enough time to stop the runs. And so, instead of fixing the math, the state changed the rules. That's the event at the heart of 1933. Not just a response to crisis, but a moment when the architecture of finance was rewritten. And now imagine that same structure, but digitized. Instead of citizens standing in line, clicking a mouse. Instead of vaults running out of gold, servers running out of access. And instead of trucks delivering currency, central banks issuing permissions. The pattern hasn't changed, only the surface has. And in a world where money is becoming programmable, where central bank digital currencies are entering pilot phase globally, the question becomes sharper. What happens when the next banking holiday doesn't close the doors? It rewrites the code. The bank holiday was not just a pause, it was a mechanism. And mechanisms, unlike moments, can be studied, replicated, and, when the conditions are right, reactivated. Here's how it worked. Step 1. Freeze movement. On March 6, 1933, Roosevelt issued Proclamation 2039. It authorized the closure of all banks for 4 days. No exceptions, no transactions, every door locked by federal order. This wasn't simply a gesture. It was a full-scale liquidity containment operation. By halting withdrawals, the government stopped the bleeding. The panic lost its momentum. Money, like water, creates force when it moves too quickly. The bank holiday was a dam, crude, effective, and immediate. Step 2. Sort the system. During the closure, federal examiners reviewed the books of thousands of banks. Solvent ones would reopen. Insolvent ones would not. But that line was blurry. The Emergency Banking Act, passed in near record time on March 9th, gave the Treasury broad power to decide which banks lived and which died, based not purely on their assets, but on the confidence they could inspire. In other words, trust became a policy variable. Banks were categorized into 3 groups: sound, shaky, and unsalvageable. The public wasn't told which was which, only that those reopening had been approved. This vague assurance worked better than detailed transparency. Roosevelt's first fireside chat on March 12th used simple language, no technical jargon, just a message. Your money is safer in a reopened bank than under your mattress. Deposits began to return the next day. Step 3. Redefine value. With cash flow stabilized and the public calm, Roosevelt executed the final part of the mechanism, the gold pivot. Executive Order 6102, issued on April 5th, made it illegal to own large amounts of gold. Citizens were required to exchange it for dollars at the official rate, $20.67 per ounce. Then the government raised the price of gold to $35. Instantly, the dollar lost 41% of its value in gold terms. But this wasn't theft. Legally, it was monetary policy. This step reinflated the government's balance sheet. The Treasury's gold reserves, revalued, allowed more dollars to be issued. That new liquidity was then injected back into the system, not through private banks, but through public works and New Deal programs. The money supply expanded, deflation reversed, and the crisis, for now, stabilized. That's the full cycle: freeze, sort, revalue. And here's the insight most overlook. This wasn't a reaction to crisis. It was a structural intervention, a system-wide reset that required legal authority, logistical speed, and psychological control. It also required centralization. Only a federal government could pull it off, and only a population in crisis would accept it. Now consider this. A central bank digital currency, or CBDC, is programmable money. It can be paused, redirected, time-limited, or geofenced. Access can be granted or revoked. Value can be adjusted, not through inflation over years, but with a keystroke. The same 3 steps, freeze, sort, revalue, could in theory be executed in seconds. No need to close physical doors, just modify permissions. No need for gold seizure, just update digital balances. And instead of radio speeches, notifications. What was once a rare mechanism, justified by extraordinary crisis, could become part of normal monetary infrastructure. Not because of conspiracy, because of design. The 1933 mechanism wasn't a fluke, it was a blueprint. What followed the bank holiday was not a return to normal, it was the construction of a new normal. Over 4,000 banks never reopened. Depositors in those institutions, millions of them, lost their savings entirely. No restitution, no insurance, just silence. Their money had been real until it wasn't. This was not fraud, it was systemic triage. The Emergency Banking Act gave the Treasury power to liquidate, consolidate, or nationalize institutions deemed unstable. Stability became the only metric that mattered, even if it came at the cost of justice, transparency, or restitution. The new banking landscape was smaller, but more compliant. The Federal Reserve, previously a decentralized network of regional banks, now operated under tighter executive control. For the first time, monetary decisions followed political objectives directly. The separation between fiscal policy and central banking began to blur, and gold, the foundation of U.S. money for over a century, was quietly removed from public hands. The Gold Reserve Act of 1934 formalized what had begun during the holiday. Gold was now the exclusive property of the state. Private convertibility was gone. The dollar's value was no longer determined by market demand, but by government decree. The economic effects were immediate. The revaluation of gold increased the nominal value of Federal reserves. This allowed for a rapid expansion of the money supply, over 10% in just 1 year. Combined with massive New Deal spending, the economy began to climb out of deflation. But at what cost? Private capital was subordinated to state control. Legal contracts based on gold payments were invalidated. Property rights, once protected by constitutional backing, were suspended in the name of public necessity. The Supreme Court upheld these actions in a series of decisions known as the Gold Clause cases in 1935. In effect, the court ruled that national economic interest outweighed individual financial contracts. It was a redefinition of sovereignty, not over territory, over money. And this shift extended far beyond America. Other nations watched closely. Britain had already abandoned the gold standard in 1931, France and others followed. The post-war global system, anchored in gold and bilateral convertibility, collapsed quietly in the early 1930s. In its place emerged a new logic, currencies backed not by metal, but by governments. Trust no longer rested in vaults. It resided in institutions. That change is still with us. Every modern financial contract, every bond, loan, or savings account operates on fiat terms. It's not backed by anything tangible. It's backed by a legal framework and collective belief. And belief is fragile. The 1933 intervention showed that belief could be maintained, but only through force, coordination, and the power to rewrite the rules midstream. And now imagine what happens when that power is no longer limited to moments of crisis. When liquidity control, account access, and monetary value are not only centralized, but automated. In 1933, the mechanism was rare, exceptional, built for a singular moment. In the near future, it could be permanent. CBDCs, Central Bank Digital Currencies, introduce a new kind of system logic, one in which every dollar is traceable, programmable, controllable. It's not science fiction, it's already in motion. China's ECNY, the digital euro pilot, FedNow in the United States. These are not speculative tokens. They are state-issued instruments designed to coexist with or eventually replace physical cash. The long-term consequence of 1933 was this. Money became a language the state could rewrite, and once rewritten, it was never returned to its original form. Then it was called a bank holiday. Today, it might be called a digital liquidity event. What happened in 1933 required paper, proclamations, and padlocks. In 2026, it may require only code. The mechanisms are already in place, not dramatic, not hidden, just dressed in modern language. faster payments, financial innovation, resilience. Let's look closely. In 2023, the U.S. Federal Reserve launched FedNow, a real-time payment infrastructure. On the surface, it's a utility. Banks can move money instantly, 24/7. But under the surface, it's more than speed. It's central coordination. When all transactions pass through a unified, state-operated clearing system, the architecture of discretion begins to shift. Speed becomes control. Now add another layer, CBDCs, Central Bank Digital Currencies. In China, the eCNY is already in pilot. Over 260 million wallets have been opened. In Europe, the digital euro is in development. And in the United States, official research papers describe a future digital dollar as a liability of the Federal Reserve. What does that mean? It means that money itself would no longer be held through banks. It would be held at the central bank directly. No intermediary, no private custody. One account, one issuer, one switch. And now imagine a crisis. A cyber attack freezes markets. A regional bank collapses. A liquidity run begins, not in lines, but online. Users try to transfer funds, withdraw balances, shift to safe platforms. In 1933, it took governors and telegrams to close banks. In a digital system, it takes milliseconds. A liquidity pause can be triggered automatically. Transactions flagged, wallets frozen for review, payments rerouted to stabilize flows. Just like in 1933, the justification will be protection, stability, trust. But the control, instant, precise, and most importantly, silent. There are no barred doors in a digital banking holiday, no headlines, just a change in access permissions. And here's the deeper insight. Programmable money is not just money, it's policy in code. CBDCs allow conditions to be attached to every unit of currency, where it can be spent, when it expires, whether it can be saved, whether it can be withdrawn. This isn't theory. In China's pilot program, some digital yuan issued during holidays came with expiration dates. Use it within 30 days or lose it. That's not currency, that's behavior, and behavior can be shaped. The 1933 bank holiday did more than stop panic. It transformed how people related to money. Depositors became subjects of policy. Wealth became adjustable. Contracts became conditional. Today, the same power is returning, but the interface is different. APIs replace auditors. Algorithms replace bank examiners. And monetary resets, once rare physical events, could become software updates, a toggle, a patch, a protocol upgrade. And if a future crisis requires it, the same mechanism Roosevelt used can be invoked digitally. Freeze movement, suspend transfers between wallets. Sort the system, authorize spending based on user profile, region, or risk class. Revalue currency. Through smart contract rules, adjust purchasing power or impose temporary exchange caps. None of this requires new ideology, only existing tools. The legal foundation already exists. The Banking Act of 1933 remains in force. The International Emergency Economic Powers Act, IEEPA, allows the U.S. President to restrict financial activity during a declared emergency. The Patriot Act and Dodd-Frank grant broad authority to monitor and intervene in transactions to prevent systemic risk. All that changes is speed and visibility, because the next bank holiday won't feel like one. It won't be declared in a radio address. It won't last 4 days. It may last minutes, just enough to restore liquidity, prevent malicious activity, or stabilize consumer confidence. It may begin not with an announcement, but with a failed payment. And the public, as in 1933, may comply, not because they understand, but because there is no alternative, because the only functioning money will be the money permitted to function. And here lies the parallel in full view. Then it was vaults and coins. Now it's dashboards and databases. Then the justification was gold. Now it's cyber risk, climate shocks, algorithmic volatility. The patterns repeat, not because of conspiracy, but because of system logic. When trust is threatened, centralization follows. When liquidity is scarce, control expands. And when currency becomes programmable, Policy becomes enforcement. History didn't change, only the interface did. The 1933 bank holiday was never just about banks. It was about control, the legal ability to freeze, reshape, and relaunch a monetary system under pressure. That mechanism, once manual and exceptional, now stands on the edge of automation. No longer bounded by vaults or weekends, no longer constrained by physical infrastructure, just logic gates and legal code. We're told digital currency will bring inclusion, efficiency, and modernization. That may be true, but we've seen this pattern before. In 1933, it took a national emergency to justify the seizure of gold and the rewriting of monetary contracts. In 2026, it may take only a policy update or a line of code. What was once rare and irreversible could soon become modular, fluid, routine. And if the state can freeze the financial system in real time, what else can be paused? Economic freedom no longer depends on what you own, but whether it's accessible, whether it's active, whether it's allowed. A banking holiday used to mean locked doors and paper signs. Now it could mean a silent update, delivered without warning, leaving no trace but a grayed out button on your screen. History doesn't repeat, it reactivates when we stop recognizing the form.